Good morning. Welcome to Flashpoint. I'm Lauren Rowe. I have questions. I know you have questions, too, as you get ready to try to figure out, what do I do in 2009? It's difficult to first understand what's going on, and second, how do you plan for your family? We'll be talking about it with some people who I'm going to get my own personal advice from. So join me in that this morning for our Flashpoint panel discussion. Tom Ruggie founded Ruggie Wealth Management in 1991. He says in the past 5 years, they've averaged about 25% annual growth rate among their clients. He's a UCF grad, was selected by the Robb Report's Worth magazine as one of the top wealth advisors in the U.S. He's been named one of the most dependable wealth managers in Florida. Tom, thanks for being here. First time on the show.
Thank you.
Back. Okay, let's get started. First of all, let's just talk about the economic stimulus plan that Barack Obama is unveiling. He seems to be trying to keep both Republicans and Democrats happy in this new plan. The big topic of conversation, or the big argument out there, is, do you create stimulus by tax cuts, or do you create stimulus by government spending? In fact, we're even seeing that trickle down into our own state government debates. The first question people have is, how long is this going to last? I mean, Tom, you sent me some talking points that I took a look at before the show, and I thought your feelings about what was going to happen were pretty promising. You said the economy may take 1 to 2 years to rebound, but you think you're going to see results of the stimulus by the second quarter of the next fiscal year.
Yeah, you know, typically there's a lag from a standpoint of once something's put into place until you actually see the effects of it. And I think that lag typically is 6 or 7 months. And the problem that we had when we started talking about the stimulus package originally is, you know, we're in a position where we needed, the economy and the people of America felt like they needed an overnight cure. And we weren't in a situation where there was anything that could be done that would solve the problem immediately. So I believe the right things are being done, and they're going to continue to be done. You know, to Sean's point, I think that one of the biggest problems we have is a confidence crisis. And I think the sooner that we can provide some confidence and some stabilization, that we are going to get to the point where we see the positive effects of what's taking place. But that being said, I still think we're in for a 1 to 2 year recession. Sure,
and again, that comes back to this you know, real confidence problem that we have. Let's talk about some of the questions that we have about the stimulus plan. First of all, one of the questions out there is, we're looking at a $1.2 trillion deficit, we believe, by this year. I believe,
before the stimulus plan.
Before the stimulus package. So the first question is it bad to continue to put our country into more debt? And the second question is, if you're going to talk about government spending projects, yeah, it's great. At least you're going to spend the money. Let's put it into something that's going to help us in the future. But you've got state governments that are already putting their spending projects on hold. Why not just hand them some more money? Your thoughts on those two issues?
I happen to think that you know, we could have a period of a deflationary period, but there's going to be a fine line with all the money that's being put out there. There's going to be a fine line between where they need to come back in and start raising those rates, which I think is inevitable that they're going to have to do to keep us from getting in an inflationary period similar to where we were in the 70s.
Yeah, there's a difference between trying to put more credit out there and giving away more free money, which kind of got us into this problem in the first place. Tom, I asked you to come up with some basics that you've been talking with your clients about, and I really just want to jump right into them.
Sure.
Investment tips for '09. The first thing you said to me is get back to basics. What do you mean by that?
Well, the model of asset allocation that we've all been using for 25 years plus, it just didn't work. There was no safe haven. The real estate wasn't safe, bonds weren't safe, the stock market wasn't safe, hedge funds weren't safe. So to me, back to the basics means putting a plan or a strategy that makes sense for you based on whatever your age is and whatever your situation is, and developing that plan and sticking to it. You know, 2009 is going to be a very unusual year in the stock market and in the economy in general. But from an investment perspective, you cannot be investing for 2009. You have to be investing for a longer-term plan that makes sense for your situation.
So if I'm not a wealth management person, I've got a basic 401k. I go pick the funds that I want. I just hit the little check mark, and I do my basic research. You know, what do you say to me? I mean, are you actually you continue to buy in your 401k? How do you get the right person to manage that fund? How do you check up on the people who are managing your 401ks or your other IRAs and things like that?
Well, for a lot of people, it makes sense to have somebody working with you, but obviously you can do your own research. The biggest thing I'm telling 401k participants is if you've got the time to weather the storm that we're currently in, keep on putting that money in there. It's on sale right now. Mm-hmm. You know, my wife loves going shopping when things are 40–50% off, and the market and investments in general is one of the only things that when it's on sale, nobody wants to buy it. So you're buying it at lower levels. The best advice that I give to people, participants of plans, is put your blinders on. Mm-hmm. Don't turn on the TV every day and keep watching that little thing go down and down and down, because it'll drive you insane.
And even for people close to retirement, though, because, you know, they're really freaked out. And a lot of people who've lost a lot of the funds that they were going to use in the next, 5–10 years are really scared about continuing to be aggressive. But do they have a choice at this point? Yeah, Sean, you can answer that too as well.
Tom's the expert here.
This is the question I have, because some of the funds, we were discussing, some of the funds that I have decided on doing was the easy way. You pick the retirement date.
Yes.
And then they're supposed to manage them with the right mix that would get you to your target at retirement date. But you have concerns about that.
I do. I've got a couple things I'll mention there. There are, I read about retirement 2010 funds. Uh-huh. Now, this is a year away.
Okay.
And at the end of November, of the 5 funds, and they were big name companies that we would all recognize, the best performing retirement date fund for 2010 was down 24%.
Okay.
You cannot be looking to retire in 1 year and have 25% of your portfolio just washed away. So that's my first concern with the retirement date funds. My second concern is, hypothetically, we're both the exact same age, and we've got the exact same retirement date that we're looking for. That doesn't mean that we should be invested the same way. You might have more or less risk tolerance than me. You might have more or less earnings than myself. There's a lot of factors that have to go into play, so just arbitrarily saying, hey, I want to retire in 2020, and everybody sticking their money into that fund, I don't think makes a lot of sense.
You think it has to be more specific?
I do.
Based on your risk and what your goal is specifically?
Absolutely.
Okay, and this one is interesting. Develop a new model with sleep well at night pools of money.
Yes.
I like that idea. How do I do that? What do you mean by that?
Well, what we've really developed is a model where we have 3 pools or tranches, if you will. And the first pool is really geared towards that sleep well at night money. I mean, it could be CDs, treasury bonds. I mean, there's other very low risk options in there. But we want enough money in that piece of the portfolio so that you're not as concerned with what's happening with the rest of the portfolio.
So basically your clients will let you play with the rest of it.
Exactly.
Right?
Exactly.
Okay. Not that they don't play with your money, but you know what I mean? So you can get a little more aggressive with the other aspects of that.
Correct.
And I think people now that are probably more serious about those safe pools of money than they have ever been before. Welcome back to Flashpoint. We're talking about your finances. And for those of us who aren't massive investors, I mean, that we have a 401k, we do the basics, we might max it, we do everything that, all of the economy people have been telling us even before this. For most of us, though, our home and the equity in that home really is the measurement of our wealth. It's the measurement of our bottom line. It's the measurement of our net worth in some ways. And so now as people see their homes' values dwindle, regardless of whether they're trying to buy or sell, the big question is, how long is this real estate problem going to last? How will it continue to affect our local economy? And who could really be benefiting from it? Tom, you start, because you still think real estate's a good deal.
Well, first and foremost, I think it's good to note that you don't have to worry about the ticker tape going by every minute showing the value of your house.
Right.
Otherwise, it would drive you.
Still feels that way sometimes.
Well, but it would drive you crazy. What I think about the real estate market is it's a wonderful time for buyers, really with any investment, but real estate certainly being in that category. It's a wonderful time for buyers, but unfortunately it's a terrible time for sellers, because all that's really being bought right now is foreclosures and people that are really having to get out. And I do believe the stimulus package is in the outflow of money that's going to hit the streets is going to help to soften this. But I heard one economist speak and said, you know, we typically have a U-shaped recovery, and in the real estate market, we're probably going to have an L-shaped recovery.